This is Matthew Cratter from Trader University, and today I want to answer the question, why is Bitcoin crashing today? I'm getting lots of frantic messages and emails. It's pretty funny actually, because when you look at it, Bitcoin is actually just falling back down to where it was trading last week or a week and a half ago. I just finished actually buying some more Bitcoin. I just bought 1.06 Bitcoin at these current prices, and I think we're fairly close to a bottom here. It took me about an hour to get Coinbase to accept my deposit, to have the money wired, ACH'd over there. And this is usually seems to be what happens when I can finally get in there and buy some Bitcoin. The bottom is close. That being said, my strategy is just to continue to dollar cost average into Bitcoin. This is normal behavior for Bitcoin. It's very volatile. It makes sure that it's very difficult for people to make money on the short side. If you tried to short Bitcoin as it was hitting new highs right above 20,000, you got obliterated. It basically went up 100%. It went up much faster and much further than even I expected. And I'm really a mega bull on Bitcoin. And now it is dropping quite a bit. And we can see that all the cryptocurrencies are falling in tandem. If you diversify across different altcoins to diversify your exposure among cryptocurrencies, it doesn't do you any good over the short term. It may over the long term if you can pick winners. I don't think any of these are winners except for Bitcoin. But on a day like this, Ethereum's down, XRP is down, etc. Everything is down. So there's no real benefit yet to diversification, at least over shorter time periods for Bitcoin. If we take a look at the chart, we saw some strong buying right as we broke below 31,000. We've been getting a lot of candlesticks like this that have long, lower wicks as the institutional investors come in and begin to pick up the slack on these pullbacks. A lot of people are citing Scott Minerd's quote today, his tweet about Bitcoin's parabolic rise is unsustainable in the near term, vulnerable to a setback. This was about 7 hours ago that this tweet came out. So this is very much technical analysis. He said 35,000 was the target, etc. This is very strange. Guggenheim is obviously, he's a CTO at Guggenheim. Guggenheim is a very long-term investor. These sort of things shouldn't really matter. But I thought Macroscope had a great take on it. The fact that it looks like, at least based on the SEC filings, that Guggenheim has been unable to buy Bitcoin this entire time. They're still waiting, as of January 2nd, they're still waiting for approval from the SEC to hold Bitcoin. And he is saying that, Macroscope is saying that as of right now, he's checked the SEC website, and this filing is still not complete. So perhaps this explains Scott Minerd's motivation for trying to put some brakes on Bitcoin. Perhaps it does, or perhaps it doesn't. People are talking about miners selling some of their inventory. Bitcoin is a free market. There are no lock limit pauses. There are no I forget what it's called in the stock market when circuit breakers. There's nothing like that. It's a completely free market. It's a very small float at this point. So it's very easy to move it around if you get a lot of buyers coming in, a lot of sellers coming in. If you understand Bitcoin, if you've been following my channel, if you're dollar cost averaging in, I wouldn't even be checking the price if I didn't have to make these videos, or if people weren't asking me about it. So I would encourage you, if you're a long-term investor in Bitcoin, maybe you watch the price so that you can buy on some of these dips. Maybe you just continue to dollar cost average in. This kind of volatility is very normal. If you're finding this video helpful, I would suggest that you hit that subscribe button and or hit the like button. Vijay Boyapati has a great tweet here talking about how in the previous bull market, the 2017 bull market, there were corrections of 30 to 40%. So this is quite normal. The corrections have been more shallow this time around. We're about 20% off the highs here. Still down, still up, I should say, 10% on the year. Vijay is suggesting that these shallower corrections may be due to the fact that they're institutional buyers who are stepping in to buy the dip. We'll see if this holds. I could see us going below 30,000 briefly. Bitcoin's impossible to It's impossible to predict in the short term. It's very dangerous to trade with leverage. This is one reason I don't use any leverage with it. You just, if you're like me, you buy it with money that you can afford to lose, and then you don't use a stop loss. I will basically hold my Bitcoin forever, whether it goes to zero, whether it goes into the multi-millions, as I expect it to do. So that's the philosophy I approach it with. If you try to use any leverage, if you try to get fancy with it, this volatility makes it almost impossible. If you have a 20% down move and you're levered 5 to 1, you've basically blown up your entire account. You're down 100%. One thing I am keeping an eye on, though, is the dollar strength that we're seeing. If you look at the Dixie, this is dollar strength against other fiat currencies. When the dollar strengthens, everything else goes down. So we've had a big plunge in gold the past few days, and today, if we take a look, we can see that stocks are down, gold is down, silver is down, oil is down. When the U.S. dollar strengthens, as it did in March of 2020, when interest rates move back up, begin to back up, it can be very difficult for risk assets, stocks, cryptocurrencies, commodities to rally. This is very strange here, actually, to seeing the 10-year note yield moving up as much as it has been. If we scroll back out, we can see that it's actually approaching, getting close to those levels that it approached in mid-March. This was the point at which the Fed had to really step in and start to buy treasuries to try to bring the yields back down. The problem is the U.S. economy is very over-financialized at this point. There's a lot of leverage in the system. And when interest rates move up significantly it puts a cap on stock prices. It hurts real estate prices. It hurts anyone who has adjustable mortgages, floating rate loans, etc. And of course, the biggest debtor in the world right now, who's very dependent on low interest rates, is of course the U.S. federal government. If yields move up too much, it makes it very difficult for the U.S. government to service its debt, and it ultimately will need to have the central bank, have the Fed print more money. So this is a very strange situation here where interest rates have moved up this much. This may be a suggestion that the economy is about to really kick back into high gear. There are a lot of projections that COVID will essentially have peaked, and with a combination of the new vaccinations and basically anyone who is ever going to get COVID, especially people who are being really careless, everyone's gotten it. And I saw some models over the weekend, I can't find them right now, suggesting that everything is peaked there, and we're about to have very good news in the coming 30 to 60 days in terms of deaths finally peaking and going down, and the rate of new infections, these sort of metrics. And it looks like, obviously, we've been getting a lot of strength in old economy stocks. We can say Starbucks opening back up, Disney, etc. Some of the airlines have had a nice little rally off the bottom. There's another dynamic at play which may be hurting Bitcoin at the moment. There have been a number of interesting editorials. The one that really stood out to me was Kevin Warsh's in the Wall Street Journal on January 4th, where he basically talks about how low interest rates in the U.S. are a bad thing for the U.S. dollar, and they discourage foreign investment, especially when you have the U.S. currency, U.S. dollar, falling versus other fiat currencies. So if you buy a 10-year note, if you're a foreign investor outside the U.S. investor, if you buy a 10-year note that's yielding about 1%, and then the U.S. dollar is falling 2, 3, 4% in the year, you're actually losing money over that time period. The only way you can make money is if interest rates move down. A lot of people betting that interest rates would move negative in the U.S. This is very difficult to happen for a world reserve currency like the U.S. dollar. So Kevin Warsh is suggesting that if we want to keep our advantage against China and prevent basically right now the renminbi and the Chinese government notes, Chinese government debt has a much higher yield. I think it's around 3%. The renminbi, which is the China's currency, the renminbi or the yuan, has been strengthening for the past few months. And so if you're an international investor, you may be drawn to something that has a higher interest rate, a higher yield at the same time that the currency itself is appreciating it. So the U.S. has a real dilemma here. It needs to keep interest rates low in order to keep the stock market booming, and also in order to keep the housing market booming, and also in order to make it possible for the U.S. government to continue to service its debt. At the same time, it's in an international competition with China for international capital. We will see in the new administration how this plays out. My base take is that Biden is going to do this, and he said he's going to do $2,000 checks for most people, and then a $3 trillion stimulus package. This sort of thing is definitely bearish for the U.S. dollar, not just against other fiat currencies, but against real assets like gold and Bitcoin. But the one wild card here is that people like Kevin Warsh, people who are trying to defend the currency, Kevin Warsh, I should say, used to be on the at the Federal Reserve. Now I think he's at the Bilderberg Group. But if these people get the upper hand and push for higher interest rates in the U.S., we could see a short-term sell-off in risk assets. If this happens, we'll have something very similar to what happened back in March, where interest rates backed up as they did over here. They really went from 40 basis points above 1.2%. At this point, the Fed had to step in, print new dollars, and start to monetize the debt. This is what will happen. Basically, there's a point at which the Fed cries uncle, the U.S. government cries uncle when stock prices fall enough or interest rates move up enough, and then the money printing has to commence again. So I don't think these are long-term risks. This could be contributing to the short-term sell-off in Bitcoin, which I do think is, obviously by the fact that I was buying Bitcoin this morning, I think it is a good time to be buying. If interest rates move up too much, the Fed will need to step in with yield curve control. In other words, buying treasuries to put a cap on interest rates and thus contain the damage. Otherwise, stock prices fall, housing prices go down. And the real problem with this is that government revenues go down, then tax receipts fall. So the U.S. government, the Fed, they really are between a rock and a hard place. If they need to defend the dollar, make it internationally competitive, at the same time, we need to do these giant stimulus packages to bring the economy back out of the pandemic. The problem with all this money printing, of course, and all the stimulus is it just makes the rich richer. The wealthy are the ones who own most of the stocks and most of the real estate, and quantitative easing, money printing, drives up asset prices, causes asset price inflation, is very bad for the lower 50% in terms of net worth in the U.S. who may be renting, who may not have access to having a stock portfolio to hedge their exposure to against inflation. And so I think the money printers win out. I think Bitcoin continues to hit new highs. I still see us getting to 200,000 by the end of the year. The wild card, of course, is the volatility of the path. If we get interest rates really pushing back up, we're going to get a mini stock market crash. We'll get probably another mini Bitcoin crash. Maybe it's already happened. But then the Fed money printers will come right back out and everything will head back up. The only way for the Fed money printers to stop is if we were to completely slash Social Security, cut defense spending, cut servicing the debt. And those are all essential and mandatory, essentially mandatory expenditures. And so I don't see that happening. We're on a one-way trip here to devaluing the U.S. currency against real assets and against probably other fiat currencies as well. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.